April 2nd, 2025 will forever be remembered as the day American industry was reborn.
The Indian Rupee just crashed 1.8% in 2025, and it's only April. As the new RBI Governor pivots to a flexible currency approach and President Trump's trade tariffs send shockwaves through Asian markets, Indian investors face a critical question. Is your financial future secured against these currency swings? For expatriate Indians, these aren't just headlines, they're threats to hard-earned wealth. Your savings? They could be evaporating as we speak. The difference between watching your savings erode and building resilience in volatile times comes down to one strategy: a properly diversified dual currency portfolio. What if you could build a portfolio that not only grows with India's rising markets, but also shields you from currency shocks, inflation, and economic slowdowns? In this video, I'll be using data, correlation matrices, and a dual currency strategy to show how you can build a portfolio that unlocks the potential of international growth. Because smart investing is all about staying ahead of the curve. Let's start with a typical scenario that many of you might recognize from your own financial statements. You invest $12,000 in an Indian fixed deposit offering 7% annual interest. After 1 year, your statement shows $12,840, a clean $840 profit. Impressive, right? But here's what the bank statement doesn't tell you. During that same year, the rupee typically depreciates against major global currencies by 5% annually. Let's do the math. Your $12,840 after currency depreciation is effectively worth only about $12,198 in global purchasing power. Your real return? Just 1.6%, not 7%. And we haven't even factored in inflation yet. This isn't a one-time anomaly. It's a persistent economic reality quietly diminishing NRI wealth for decades. To build an effective dual currency portfolio, you need to understand the broader economic landscape, and that means looking both at India's strengths and the global counterbalance. By this point, we are all aware that India is outpacing major global economies. But it's all buzz, unless quantified. According to a report by ASK Investment Managers, the Indian markets have outperformed the US, China, and other major markets in the last 3 years, 5 years, and 10-year horizons. Credit Suisse's Netra Early Signs report from 2023 shows the Indian stock market has outperformed the US, China, and the world equity markets in terms of real returns over the past 123 years, with an average annual return of 6.6%. But don't get carried away. This growth comes with structural traits that shape how you should invest. Interest rates in India are typically 4 to 6% higher than in developed economies, not as a reward, but as compensation for higher inflation and currency risk. Inflation, too, has historically run hotter, slowly eating into purchasing power. And the rupee? It has depreciated at an average of 4% annually against the dollar for the past 2 decades. These are not short-term events. They're patterns baked into the structure of the Indian economy. Now contrast that with the global picture. Developed markets like the US, Europe, and Japan may grow more slowly, but they offer stability, low inflation, strong currencies, and highly liquid capital markets. Understanding these dynamics isn't about favoring one market over another. It's about recognizing that each has its role. India offers growth. Global markets offer stability and insulation. A well-structured dual currency portfolio aligns your wealth with where the world is growing, not just where interest rates look tempting on paper. At the core of this strategy lies a deliberate balance. Nearly half your portfolio is allocated to global equities. These are businesses driving innovation and global trade that offer consistent returns in stable currencies. Complementing this is a meaningful allocation to global fixed income, government and corporate bonds from mature economies, chosen not for excitement, but for the quiet strength of predictability they bring to your portfolio. Back home, Indian equities continue to play a vital role, particularly those with global footprints. Export-oriented businesses and firms generating revenue in foreign currency. These act as a natural hedge against rupee depreciation while still letting you participate in India's growth story. Real estate in India also holds its place, not just for its appreciation potential, but for the rental income it generates and the geographical grounding it offers if you plan to return someday. And then there are the alternatives. Gold, for its timeless ability to preserve value, real estate investment trusts or REITs, which offer property exposure without the hassle, and inflation-indexed bonds or IIBs, government-backed instruments that adjust your principal and interest to match inflation. Together, they round out a structure designed not just to survive volatility, but to thrive in it. If you are planning to return to India permanently, you might increase your rupee exposure. If you're settling elsewhere, you'll want more emphasis on global assets. But how can you ensure that your hard-earned money works across multiple geographies and currencies? The answer lies in understanding the investment vehicles available to you, whether in the US, Europe, the Middle East, or India. In the US, NRIs have long had access to some of the most well-regulated markets in the world. But it's not just about buying stocks. The real opportunity lies in tax-advantaged investment vehicles like individual retirement accounts or IRAs and 401k plans. These options help you grow your wealth while deferring taxes on your returns until retirement, providing advantage for long-term investors. Here's a catch. IRAs and 401ks are only accessible if you've lived and earned in the US. But global ETFs, UCITS funds, REITs, and mutual funds are widely accessible through global brokerages, even if you're living on an island in Fiji, as long as local laws allow outbound investing. The UK has historically been a stable market, but recent volatility in the pound and low interest rates have created a unique set of challenges. Consider UK pension schemes. They're one of the best ways to lock in tax-free growth on your investments. But here's a catch. While the pension might sound appealing, its returns could be limited due to currency fluctuations when you eventually repatriate the funds. That's why many NRIs look beyond traditional pensions. For those eligible tax-efficient wrappers like individual savings accounts or ISAs, and lifetime ISAs, LISAs for short, offer powerful incentives, tax-free growth, and withdrawal benefits within the UK system. But to truly future-proof your savings, you'll want international diversification. Global equity and bond funds, especially those focused on AAA-rated economies, can hedge against local currency swings. They offer more than just returns. They bring stability in hard currencies like the dollar or euro and a safeguard against domestic shocks. Europe, long viewed as a safe haven, still offers valuable opportunities, but not without its nuances. Returns that look healthy in euros might not translate well into rupees if the exchange rate shifts. For instance, the euro swung between 88 rupees and 97 rupees in just the first few months of 2025. A nearly 10% fluctuation that significantly impacts real returns. That's why it's wise to pair European holdings with global REITs. Europe has seen the largest growth in REITs since 2020, with 62 REITs added, indicating a 31% growth. The Middle East offers NRIs a compelling advantage: tax-free income and rising financial hubs. On paper, it looks ideal. But dig deeper, and you'll find the local investment ecosystem isn't as mature. Real estate continues to be the most viable option. Cities like Dubai offer high growth potential. Yet, the asset comes with trade-offs. It's illiquid, long-term, and exposed to regional economic shifts. That's why it's smarter to pair property in the Middle East with stable instruments. Think gold and fixed income securities denominated in strong currencies. Importantly, for NRIs in the GCC, Sharia-compliant investment products are widely available and often preferred. These offer ethical investing aligned with Islamic principles while still allowing access to global equities. Islamic bonds called sukuk and real estate, broadening your portfolio without compromising on values. Thrive in the Middle East by leveraging both local tax benefits and global diversification tools. So how do you bring it all together? Whether you're in the US, UK, Europe, the Middle East, or right here in India, one truth stands out. True diversification isn't just about spreading money across borders. It's about holding assets that behave differently when the world shifts. That's where a correlation matrix becomes your compass. A correlation matrix is a table that displays the correlation coefficients between pairs of assets, indicating how they move in relation to each other. The coefficients range from -1 to +1. A +1 indicates perfect positive correlation. That is, assets move in the same direction. 0 suggests no correlation, or that assets move independently, and a -1 points at perfect negative correlation, or that the assets are moving in opposite directions. Let's understand this by an example. Imagine you hold US equities, Indian stocks, some global bonds, REITs, and gold. At first glance, it seems diversified, but a quick look at their correlation tells you a deeper story. Gold barely moves with Indian or US markets. Global bonds actually move opposite to equities. And while Indian stocks mirror US equities to some extent, REITs sit somewhere in between. This matrix helps you make smarter allocation decisions, not just across borders, but across behaviors. It allows you to ask, is your portfolio just globally spread or truly globally resilient? Are you hedged when inflation rises or when a currency crashes? In a world where returns shift with geopolitics, inflation, and volatility, this one tool helps ensure your money isn't all riding the same wave. In the description, you shall find a mock correlation matrix to get you started. At NRI Shala, we understand the unique challenges facing global Indians. We're publishing new videos every day, curated specifically for our community. So do subscribe and share with fellow NRIs.